Dispelling the most common myths about ESG investing. ESG, environmental, social, and governance, has become a popular catchphrase in the investment management world. There are now a multitude of investments that claim to be sustainable, green, ethical, and social. The meanings of these terms are almost as numerous as their appearances. This confusion is being exploited by some players for quick profits, and the terminology is drowning out the essence of ESG investing. The majority of issuers and market participants are simply appropriating the interest and the corresponding financial resources for short-term profits, which should otherwise be destined for real positive change and innovation in investment management. The fundamental issues of ESG are about expanding and modernizing the approach to investing with a culture of transparency, good business practices, and long-term risk management. Here are some of the most common misconceptions about ESG investing. Myth number 1. ESG investing is about exclusion. This is a carryover from socially responsible investing in the 1980s and was mostly about excluding certain companies from portfolios due to political, ethical, or other criteria. Think anti-apartheid, tobacco, and firearms. ESG investment certainly identifies political, ethical, and social risks, but the decision whether or not to invest in certain companies is another process that comes after ESG has been integrated. Myth number 2. ESG investing diminishes performance. Being informed of additional risks that are predominantly non-financial has no negative influence on the performance. For instance, you could integrate ESG factors into your current portfolio without changing a single position, and you would thereby retain your current performance. However, with the added insight that the non-financial factors provide, you will probably wish to change your exposures to avoid some of the risks that the integration of ESG factors will expose. Myth number 3. ESG investing is a theme. Traditional investment managers would like you to think so. Need a little feel-good position in your portfolios? Then buy a fund or an ETF with green, climate change, carbon neutral, or some other catchphrase in the title. This is not what ESG integration is about. ESG integration is above all a comprehensive risk management tool that helps you to identify risks to your investments that are not expressed using pure financial analysis. Without ESG integration and an ESG investment strategy, you will likely compound your risks and duplicate your positions while erroneously thinking that you are saving the planet. Myth number 4. ESG investing is philanthropy. ESG investing is not philanthropy. ESG investing is about investing in companies for profit. By investing in companies in which you acquire measurable insight into their business practices and their social and environmental impact, you can ensure that your long-term performance is properly risk-adjusted. Myth number 5. ESG is the same as impact investing, ethical investing, green investing. ESG integration enlarges the scope through which you evaluate your investments. How you use the additional data in the choice of your investments is then a question of your objectives. It can certainly lead to ethical, impact, and environmental considerations within your portfolio. It should change the way in which you invest. ESG integration will identify risks that you will want to take into account in your investment decisions. The information provided by ESG criteria allows you to construct your portfolios to fulfill more than just pure profit objectives, but not necessarily at the expense of performance. Find out more about ESG integration, ESG investing, and how you can prepare your financial services company for the future. Ataraxia. ESG integration for financial professionals, by you, for you, and done right.